Greetings, accounting students. Today we're going to look at the completion of an income statement. And this video is on the back of a theoretical video I made about the completion of the income statement. So you can check that out on my channel, Income Statement Part 1. And I am pitching this video to my Unit 1-2 students. We are working with a single entry system, so looking at posting from the completed special journals for a reporting period along with some subsidiary records, as opposed to posting from the general ledger and a trial balance, which is what we would do for a double entry system in the Unit 3-4 course. So what I've got here is an example of 4 total special journals for the month of June 2024, and I'm going to justify why each of the items will or will not appear in the income statement. So let's start with the CRJ, working right from left. We've got some GST collected here. Now that GST represents an obligation to the ATO, so that is a liability. Won't go in the income statement. Sundries, 10K for a capital contribution because of the entity assumption. We will report that separately. That will be owner's equity in the balance sheet. A loan received, that represents it creates an obligation to the bank that will require that to be settled in the future. That is a liability that won't go in the income statement. So sundries dealt with. Cash sales. Cash sales is revenue. It results in an increase in assets in the form of bank balance going up. And we also have a simultaneous increase in OE that's occurred in the ordinary activities of the business. Now, accounts receivable, here's a common trap. We do not want to double record this as revenue. We've already recorded at the point of sale the actual revenue in our sales journal when we have a credit sale. Now, the entry in the accounts receivable is later on when our credit customers have settled their debts. So what we have in this column is simply a change in our assets. Accounts receivable, that asset's going down in exchange for the bank going up. So it's not revenue. Discount expense, obviously an expense. So, and the bank balance, well, that's basically going to impact our assets. Now let's get to this sales journal. So this is for our credit sales. So our sales is obviously revenue. So we could combine, but we will report them separately in the income statement, our cash and credit sales. The GST charged to accounts receivable is a liability, as we discussed before, and that total is an asset that will impact the balance sheet. So let's look at the cash payments journal. So again, our GST paid will reduce our liabilities, offset the GST that we collect and charge. Our sundries, we've got some drawing, so that's negative owner's equity because of the entity assumption. Electricity is an expense because it will decrease assets in terms of the bank balance when we paid it, and there's a simultaneous decrease in OE that's occurred in the ordinary course of business. Same with interest. The cost of a loan is an expense, decreasing assets and a simultaneous decrease in OE. The freight on inventory, well, that's going to go in our cost of goods sold because it's a cost incurred in getting the inventory into a location ready for sale. So there's another expense. Sundries have been done. Wages, also an expense. Inventory is an asset because we're buying that. We will sell it in the future. I'll talk about cost of sales a bit later. Accounts payable, so that's when we're paying off amounts owing for inventory purchased on credit. So that is a liability being reduced. Discount revenue, well, that's going to be other revenue. And our bank balance, again, that impacts our assets. If we look at our purchases journal, we've got inventory purchase, so that's an asset going up. we've got some GST that's been charged, so that's going to offset our liability to the ATO, and we've got an increase in liabilities in terms of our total accounts payable. Now, we don't have all of the information that we need in order to complete the income statement, so we need to look at our inventory cards, possibly our subsidiary records, to get some additional information in the single entry system. So what we could do to work out our cost of sales is we could look at the out column of our inventory card. We just need to be careful for some of the non-sales items, like for instance, if we have a purchase return or an inventory loss, etc. But just to make it a bit simpler, we can look at the markup. The markup, as it's got here in the additional information, is 100%. So that means that our cost of sales will be exactly half of our sales revenue, because if we mark it up by 100%, we're going to add the value of that inventory purchased. We're going to double it so that we sell it for twice what we actually purchased it for. Inventory loss and inventory gain will basically both go between our GP and our adjusted GP. And you might say, how could you have an inventory loss and an inventory gain in the same reporting period? Well, if we have different lines of inventory, we might have a loss due to underdelivery or theft of one type of line, and we might have an inventory gain of another type of line because we might have undersupplied a customer or had an oversupply from a delivery. Our sales return, well, that's going to impact our net sales, so let's be mindful of that. And purchase returns has no effect on the income statement. It simply will reduce the amounts owing on our accounts payable and also reduce our inventory balance. So with all of that in mind, let's have a crack at completing the income statement. So let's start with our cash sales from our cash receipts journal, 25.5K. Then we get our credit sales from our sales journal, that was 18,600. We had some sales returns in our additional info, 800. So if we total those three up, keeping in mind that the sales returns is a negative figure, then we get 17,800. That's 43,300. I hope my maths is good there. Alrighty. Then we list our cost of goods sold. Now, the net sales is 43,300. The markup was 100%. So remember what I said before in terms of the cost of sales being exactly half of the net sales, including sales returns. So therefore, half of 43.3, that's 21,650. And we also had some freight in, $1,000 that we've seen in our payments journal. So total those up and we get 22,650. Deduct that from your net sales here, and that gives us a GP of $20,650. Now, that's a measure of our markup, but we had an inventory loss and a gain. So the gain is the positive figure, 200. Our loss was the negative figure, 500. So that gives us a net negative 300. So our adjusted GP is our gross profit minus the combined effect of those two. So that takes us down to 20,350. Now, in terms of our non-trading revenue, we had some discount received from our accounts payable for prompt payment. So that was $300, which we find in our payments journal. So let's park that for now. We also had some expenses, some non-trading expenses, which you'll find in your payments journal. We had 11K for wages. Electricity was $2,200. And we had some interest on the loan at $80. If I total up those expenses, that's $13,280. So if I deduct that from the $20,350, that's $7,070 plus the other revenue, $7,370. That's very messy, but hopefully we get the gist of that.